So, you want to drive for Uber and Lyft. Well, you might want to pump the brakes once or twice before you buckle in. Think about some of the tax implications that come with the junk in the trunk, if you know what I mean. But before I get into it, be sure to subscribe to this channel and comment below on other tax tips you want to learn about. First place to start is to realize that now you are your own business. You're self-employed and you have to file your taxes correctly. So what does filing your taxes correctly look like? Well, the IRS says that if you earn $600 gross income or $400 net income, you have to file what's called a Schedule C reporting net income. What's a Schedule C? Well, Schedule C is where you list out your gross income, the total amount that you receive from Uber or Lyft, and then you also list out the expenses, stating what it costs you to earn that money. So along with that, there's another form that you have to file called a Schedule SE. The Schedule SE is where you actually report self-employment taxes. Self-employment taxes are very similar to Social Security and Medicare for W-2 people who are working a regular job. All of that combined goes into your regular 1040 return that gets filed every year. So every year in January, approximately, you're going to get maybe one of a couple forms from either Uber or Lyft. The funny thing is, you'll actually never get a form from Uber. You'll actually get it from Uber's parent company called Ryzer. What these forms will either be maybe a 1099 miscellaneous or a 1099K. The total income reported on those forms is going to be what's called your gross income. That's the total amount that you earn. But thankfully, that's not the actual amount that you have to pay taxes on. It costs you something to earn that money, and thankfully those expenses are deductible. So as you can imagine, it costs you something to earn this money. There's a lot of expenses that go into driving for Uber or Lyft. One of the big expenses is a vehicle. You either have to use your own or you have to rent one. Now, if you're using your own, there's two main ways to try to track expenses. You can either use what's called a per mile rate, which is all encompassing and takes care of all the expenses related to the car, such as fuel, gas, insurance, and things of the like. There's the other side of it, which is where you track your actual expenses. This one's really hard because you end up having to keep receipts on all of your fuel bills, all of your oil changes, any maintenance, everything you have to keep proof of if you want to claim it. Along with the vehicle, some rideshare drivers love to have a little special goodie bag for any of their riders, and that can be deductible too. Part of your phone plan could be deductible, any special insurance that you had to buy could be deductible, or any other expenses that directly go to producing that income. And all of those expenses come together to get to what's called your net income. That net income is what you actually end up paying taxes on. So keeping track of all those expenses is crucial. One of the best ways to keep track of those expenses would be to keep a completely separate bank account. Have only your rideshare income go in there and have only your rideshare expenses come out of there. At the end of the year, all you have to do is look back on that bank statement to help figure out what your expenses were. It'll also make your accountant's job a lot easier. Well, when you're self-employed, you have to pay self-employment taxes. Similar to a W-2 employee who has taxes withheld from their check throughout the year, it's now your responsibility to pay those throughout the year. Those payments throughout the year are called estimated tax payments. The IRS requires estimated tax payments to be made 4 times a year. Those 4 times are on April 15th, June 15th, September 15th, and January 15th of the following year. Now, if this is your first time doing Uber or Lyft, you might ask the question, well, how do I know how much to pay? And there's a few different ways that'll help you out. So the quickest way to figure out how much estimated taxes you should be paying is usually to take a look at last year's tax return. If you take the total tax due and divide by 4, that's approximately how much you should pay per year. Now you may say, but this is my first time. I can't look back on last year's tax return. So what do I do now? Well, you can use one of two ways. There's the short form way, which you pretty much take about 25% of your gross income and put it to the side for estimated taxes. The second way is that the IRS has a long form called a 1040 ES worksheet. On there, you have to list all of your anticipated income and deductions to figure out how much you should pay. No matter what calculation method you use, it's crucial that you actually make the estimated taxes. This is one of the best ways to save money with the IRS. If you make them on time and make at least 90% of your total tax bill, there's no penalties from the IRS. But if you don't, the IRS will be happy to assess a penalty because the estimated taxes weren't paid. As you can quickly see, this easily gets pretty complicated. So it might be best to reach out to a tax professional like the attorneys and accountants we have here at the Gordon Law Group. And as always, be sure to subscribe to the channel, like this video, and comment down below on any other tax topics you want to learn about.